Back in 2024, I made a prediction. I said that the Federal Reserve would be forced to restart the money printing process again in 2026. And now, here we are. 2026 is no longer some distant year in the future, it's right around the corner. So the real question is simple: are we on track for the Federal Reserve to start printing money again? And today, I want to show you exactly where we stand, using the Fed's own words. The statement most people missed. In November, something very important happened. The president of the New York Federal Reserve, John Williams, made a statement that went almost completely unnoticed by the public. He said that the Federal Reserve will soon need to grow its balance sheet again. Now, that sounds technical, but let's translate that into plain English. Growing the balance sheet simply means one thing: the money printers are coming back on. And what's important here is the timing. Williams didn't say years from now. He didn't say maybe. He said, I expect it's not going to be long before it happens. That's a very strong statement. In November, something very important happened. The president of the New York Federal Reserve, John Williams, made a statement that went almost completely unnoticed by the public. He said that the Federal Reserve will soon need to grow its balance sheet again. Now, that sounds technical, but let's translate that into plain English. Growing the balance sheet simply means one thing: the money printers are coming back on. And what's important here is the timing. Williams didn't say years from now. He didn't say maybe. He said, I expect it's not going to be long before it happens. That's a very strong statement. Are we really headed for QE again? So let me answer the big question directly. Are we on track for the Federal Reserve to restart large-scale money printing in 2026? Based on everything we're seeing right now, my answer is yes, and this isn't speculation anymore, because we now know exactly where things officially stand. Quantitative tightening is ending. Quantitative tightening, also known as QT, officially ends on December 1st. This is not a rumor. This is not an opinion. This has been confirmed by the Federal Reserve, and I want to make sure we're completely clear on definitions before we move forward. Quantitative tightening, also known as QT, officially ends on December 1st. This is not a rumor. This is not an opinion. This has been confirmed by the Federal Reserve, and I want to make sure we're completely clear on definitions before we move forward. Q vs QT. Simple explanation: quantitative easing, or QE, is just a fancy way of saying money printing. You'll hear it called different things: balance sheet expansion, QE, reserve growth, asset purchase, but they all mean the same thing. The Fed creates new money and injects it into the financial system. That increases liquidity. It energizes markets. It pushes asset prices higher. Quantitative tightening, or QT, is the opposite. QT removes money from the system. So, QE equals adding liquidity. QT equals draining liquidity. And now, Kate is ending. Why too much money is a problem? Here's the key issue: when there's too much money in the system and too much liquidity, you get more cash chasing the same goods and services. And that causes prices to rise. Inflation. Now, this wouldn't be a problem if everyone received the same amount of newly printed money. But that never happens. New money flows first into banks, financial institutions, markets, not into everyday paychecks. That's why asset prices rise faster than wages. What happened after the pandemic? Let's do a quick recap. During the pandemic, millions of Americans were told to stay home and stop working. That effectively shut down the economy. To prevent a total collapse, the government and the Fed printed trillions of dollars. They had no choice. People still had bills to pay, but here's the problem: they overdid it. Too much money was printed, and that led to the inflation surge we've been dealing with ever since. The balance sheet shrinking. Because inflation got out of control, the Federal Reserve had to respond. Over the past 3 years, they've been shrinking their balance sheet. It peaked near $9 trillion. They brought it down to around $6.60 trillion. That means they've been actively pulling money out of the system. That's QT. But now, that process is stopping. Why? The Fed is stepping back in. So why is the Fed reversing course now? Is the economy crashing? No, not yet. Is there a major recession happening today? No, the real reason has nothing to do with stimulus. It has to do with financial plumbing. The financial plumbing problem. The financial system runs on reserves. Think of it like a plumbing system. If there's not enough water in the pipes, the system stops working properly when reserves fall to low. Repo rates spike, money market seize up, liquidity breaks. We've seen this before. 2019 repo crisis, 2020 pandemic early. Signs again in 2025. The Fed isn't stepping in to boost the economy. They're stepping in to prevent the plumbing from breaking. What happens when the Fed expands again? Even if the Fed claims this isn't stimulus, the effects are always the same. When the balance sheet expands, liquidity increases, real yields fall, valuations rise, risk-taking increases. That puts upward pressure on stocks, crypto, real assets, and that's where the melt-up comes from. Ray Dalio's warning. This isn't just my view. Ray Dalio, founder of Bridgewater, one of the world's largest hedge funds, has been warning about this exact setup. He says the ingredients are already in place: high stock prices, large fiscal deficits, persistent inflation, and now new money printing. Dalio believes this combination creates a dangerous bubble. How the melt-up ends. According to Dalio, liquidity will push asset prices higher and higher until inflation becomes the severe. At that point, the Fed will be forced to slam on the brakes, and when that happens, the correction will be violent. So yes, a melt-up can happen, but melt-ups don't last forever. Major policy shift coming. There's another factor most people aren't paying attention to. Jerome Powell's term as Fed chair ends in May 2026, and who will choose the next Fed chair? The president. President Trump has been very clear about his views. Interest rates are too high. The Fed should support growth. Borrowing costs should be lower. That points toward a more dovish Federal Reserve, putting all the ingredients together. So let's summarize what we're dealing with. High stock prices, large government deficits, inflation still above target, QT ending, QE likely restarting, a more dovish Fed leadership. That combination has melt-up written all over it. The bottom line. Call it QE, call it balance sheet expansion, call it reserve management. It doesn't matter. Liquidity is coming back into the system, and historically, that pushes asset prices higher. Practical takeaways. Let me leave you with a few practical points. First, follow liquidity, not headlines. Markets respond to money, not press releases. Second, don't chase parabolic moves. Melt-ups don't go straight up. Buy pullbacks, not euphoria. Third, diversify. In liquidity cycles, stocks can rise, crypto can rise, precious metals can rise, and nobody knows which will lead. Fourth, be careful with leverage. Margin debt wipes people out even in bull markets. Many investors lose everything not because they're wrong, but because they borrowed too much. The Fed is warming up the money printers. Interest rate cuts come first. QT stops next. Q follows. And history suggests inflation will re-accelerate. Every cycle requires more money than the last. Like an addiction, and that never ends well. Stay informed, stay disciplined, and don't ignore liquidity. Thank you.